there's panic in the bond market, and in today's show, you'll learn why. Yields are spiking. I'm your host, Steven Van Metre, and thanks for joining me today as interest rates have been going vertical over the past several days as panic rolls through the bond market and traders are eager to get short. But the question is, what's driving this move higher in yields? And are these traders on the wrong side of the fence? Well, let's take a look and see where the story goes as Treasury yields jump as conviction on Fed hikes grow. According to Bloomberg, key economic data pose risk of earlier rate hikes, and 2 years yields exceed 0.8%, the highest since March of 2020. And benchmark yields climbed across the curve, led by the 10-year, which jumped as much as 13 basis points and exceeded 1.6% for the first time since the Omicron variant emerged in November. That was the 10-year yield's largest first-day increase since 2009. According to data compiled by Bloomberg, the 30-year yield climbed as much as 14 basis points to top 2%, while 2-year yield surpassed 0.8 to reach its highest level since March of 2020. March will be a live meeting, and stronger data this week means it's not inconceivable we see liftoff that early, says the head of U.S. rates at Amerivet Securities in New York. Quote, the move higher in rates is not surprising as the market expects the Fed will lift off this year. In fact, that is some of the concerns we're seeing here is a potential earlier than expected rate hike. But let's keep going and see where they go with this, because here you can see the rising yields as New Year's selling, keyword being selling. This isn't being driven by just natural forces. This is driven by traders selling and shorting the bond market to drive yields higher. And of course, what we then find out is perhaps maybe they're going to be wrong as we look at this piece from the same article titled Negative Returns. That outlook raises a prospect of negative Treasury returns for 2 consecutive years, a performance that would be unprecedented since records began in 1974. The Bloomberg Treasury Index provided a total return of minus 2.3% in 2021, its first slump in nominal terms since 2013. The index in the past has rebounded after a down year, with gains ranging from 5.1 and 18% after negative returns in 94, 99, 2009, and 2013. And do you know what's significant? In 94, there was a mild recession. 99, we were at the peak of the dot-com bubble. In 2009, we're coming out of the great financial crisis when bond prices skyrocketed. In 2013, we're coming out of a double-dip recession. And so what you can see is perhaps that these traders are on the wrong side of the fence at the wrong time. And that makes it interesting for sure. Let's keep going, because the sell-off in treasuries looks to have been driven by traders renewing their short positions in rates markets after closing their books for last year in mid-December, according to NatWest Markets. And here we can find out if those traders are right or wrong. And I've got the federal funds rate in blue, that they're panicked that the federal funds rate is going to go up earlier than expected, perhaps starting the March meeting. And there was a point in time when the Fed had control over the yield curve, meaning they could, by moving the federal funds rate, they could impact 2-year, 10-year, and 30-year Treasury yields. But that changed, and you can see it here in 2000, following the dot-com bubble. What you'll notice in red is 2-year Treasury yields, and they started to lead the federal funds rate higher. But notice here in green, you've got the 10-year Treasury yield. It went flat, was virtually unchanged, despite the fact the Fed was hiking. And look at purple here. You see the Dr. Purple of the 30-year Treasury yields. And what was it saying? Hey, we don't buy into this growth story. Fed, you've got it wrong. And 30-year yields actually went down. And here you can see again, coming out of 2016, what happened? 2-year Treasury yields were leading and brought the federal funds rate higher. But 10-year Treasury yields actually went down early in the rate hike cycle and pretty much ended flattish. I mean, they were up a little after that, but overall they were flat. How about 30-year yields? They went down too early into the rate hike cycle before starting to buy into that growth narrative. And I think that is the story, because we've got New Year's sends Treasury yields higher, according to the Wall Street Journal, as returning traders bet Omicron COVID-19 variant won't shift central bank policy in months ahead. And you know, I think those traders are right. Other factors, including higher than anticipated inflation, the inflation story we're going to talk about here, and tightening labor market are expected to keep pressure on the Federal Reserve to raise interest rates in 2022. Analysts say most central bank officials in projections released in December penciled in at least 3 quarter percentage rate increases in 2022. Now, the question is that you should be asking, what is the story about inflation and yields? Because the popular view is that yields respond to inflation, but maybe it's inflation responds to yield. And let's take a look at this chart I put together here. And what do you see? The consumer price index in blue, the dark bolded one. And then you see the treasury yields from 2, 10, and 30s from the same colors we had before. And you'll notice at first glance, there really isn't a relationship. But when you start looking closer, where yields go, inflation follows. And that's real key, because inflation, my friends, is not a leading indicator. It's a lagging indicator. It's a look back indicator. So what do treasury yields tell you? They tell you about future growth and inflation expectations. So when yields are falling or flat and inflation's rising, well, it already tells you where inflation is going to go, and you can see that here. This is a good example. It's a great financial crisis. Inflation was rising, yields were falling, and what happened? Inflation came crashing down, and what do we see now? Inflation rising, yields actually down from their peak, going sideways, and that's telling us that inflation story is about to end. And wow, whether it be this month or next, I don't know, but it will come to an end. But if you're concerned about any of the stuff with the Fed or inflation and your portfolio, well, you shouldn't be. Check out Portfolio Shield when you get a chance. I'm sure you'll see why it's so great. All right, let's continue on with the story, because it doesn't end there. The Fed's rate setting panel gets new members in 2022. More uncertainty, and the market hates that. Amid rate rise expectations, the annual rotation of committee members, mean chiefs in the Kansas City, St. Louis, Cleveland, and Boston banks will join. The leaders of the Fed's Kansas City, St. Louis, and Cleveland Boston Reserve banks will become voters in 2022 on the Federal Open Market Committee under the panel's annual rotation system. Giving up voting slots will be the chiefs of Atlanta, Chicago, San Francisco, and Richmond Fed banks. The shift is unlikely to significantly alter the course of policy, coming after all Fed officials signaled their December 15th meeting they're expecting to raise interest rates in 2022. But changes will draw more public attention to some of the Fed's so-called hawks, those officials who tend to favor a more restrictive and less stimulative policy stance than their colleagues. In fact, one of those is Kansas City Fed Chief Esther George, who I think we're going to hear a lot from in the coming years, is one of the central bank's most consistent hawks, having dissented in more than half of her past FOMC votes, always in favor of tighter monetary policy than that preferred by her colleagues. She and St. Louis Fed President James Bullard were early advocates for withdrawing economic stimulus in 2021. And so where does this go? Well, the key is that traders are looking at the 2-year treasury yield and drawing a correlation to the 30-year, assuming that we should see higher 30-year yields because 2 years are going up. And if you understand that from a trader perspective, you would then want to be short or sell the 30-year whenever possible, because you believe rates are going up. And what did we point out earlier? And here we'll make it a little easier to see. We have in blue 2-year treasury yields, and in red, 30-year. And what do you know? As 2-year yields go up, 30 years went down, following, again, the dot-com bubble. And here we can see 2-year yields going up, 30-year yields not really agreeing with it. So there isn't much of a relationship, but in traders' minds, there is. But the real issue comes on the 2-year, has more to do with this overnight reverse repo. Now, you may recall last year we discussed that the Fed was trying to raise short end of the curve. They wanted the front end, the short-term yields, to rise. That was their objective, and they did some things to make that possible. And now we're seeing that actually happen. And so we have a huge amount of money sitting in overnight reverse repo, which is money market funds that do not have enough treasury securities as collateral to back them. So the Fed is backstopping money markets. And what these money market funds need are lots of treasury bills. And so without them, that puts upward pressure on the front end of the curve. And now the Fed's got a huge problem because they're sitting on a $1.7 trillion issue that they haven't even talked about. And perhaps that will be the big story for the upcoming Fed meeting at the end of this month is, will the Fed start to pull in the reins on its reverse repo? Because let me show you what that looks like here. And you can see that there it is, 2-year treasury yields are reacting to all of this reverse repo, this money that is cash in the system that is not backed by treasury securities. And you can only imagine where yields would be if the Fed said, we're going to stop all this reverse repo madness. Yields would go negative because there is too much money and not enough treasury securities. And well, here you go. I'll show you from the Federal Reserve Bank of New York. If you look at dealer positions in available T-bills. Now remember, the problem is 1.7 trillion and there's $13 billion of T-bills sitting in inventory waiting for someone to buy them. There isn't enough collateral. In fact, we go out to the 2-year note and there's only 21 billion. There's virtually no 3-year. In fact, there's a massive shortage across almost the entire curve because there's such a huge demand for treasury securities. In fact, that demand just isn't in the reverse repo. If you missed the Friday show on New Year's Eve, the latter half of it, we talked about all of this bond stuff and why banks have to keep buying bonds. And one of those reasons is this loan to deposit ratio in blue. And what's happening is there aren't enough loans out there to back all the deposits, which forces the banks to buy more treasury securities. And this relationship got kicked off following the great financial crisis when the number of deposits far outpaced the number of loans. It used to be very close to 1-to-1 ratio, which means that even though traders are shorting and selling bonds trying to drive rates up, the banks are buying them up because they need them. They need them to back all of those deposits. And that's how you know that, of course, the story doesn't end with higher interest rates. It ultimately ends with lower interest rates. But now you know what's driving this recent spike. It's traders panicking over the Fed. And as you now know, they're in the wrong, which presents an opportunity for what we learned in 94, 99, 09, and 2013, that the year following is usually a big year for bonds. And with that, we'll look forward to it. I'm Steve Van Metre. Thanks for watching. We'll see you back soon. Bye now. The content of this video provides educational information only. It's not intended to provide investment or advice. It should not to be construed as recognition or solicitation by a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not affect the value of Financial Advice Inc. or Steven Van Metre Financial.